how do we minimize tax? What are some of the ways that people can do it?
Just remember one thing, depreciations.
Depreciation. Okay. So depreciation, what is it?
So basically it is when you buy an apartment, there's two components within your apartment. One is the construction cost, and there's also plant and equipment. The ATO basically allowed a taxpayer to slowly deduct those amounts on a yearly basis. So let's say if you buy an apartment for $500,000 and once you get a qualified quantity surveyor to give you the depreciation schedules, the annual deductions might be around 10 to 15,000 each year that goes against your income. So,
okay, 10 to 15,000 per annum.
Yep.
Now, I understood everything you said, but you know what? For most of my listeners, they didn't understand a word you were saying. It was technical, it was hit. I'll put it simply to you. Think about it. You buy a fridge every year, it gets older and older and older, and after about 5 to 10 years, you throw it in the bin. Now, the fridge in your home, you throw it in the bin and that's it and it's done. What Derek was talking about is that if you're an investor, you pay for that fridge on day one, okay? Then every year, as it gets older, you can deduct a percentage of that fridge. So let's say in simple terms, it was a $10,000 fridge, bloody expensive fridge, but I'm doing this for the simple maths. And on a very simple basis, we said it would last for 10 years. Every single year, you can deduct $1,000. So you add up all those expenses and that's how you get to this figure here.
Done by the, yes, correct.
Yeah. Now, obviously you need a professional, a quantity surveyor. There's a lot of paperwork that needs to be done around it, but that is a big, big saving. So, you know, can we perhaps do a worked example? You know, let's say that we have, you know, let's say in scenario 1, you know, we don't have any depreciation. Scenario 2, we do. So let's say the rental income is $30,000, okay? We have expenses, you know, council rates, taxes, water rates, whatever it is, of say $10,000. Okay. So we're left with $20,000 in our pocket at the end of the year.
Yep, before depreciation, correct. Yep.
So in our scenario 1 where we don't have depreciation, we're going to pay tax. Now, I don't have a calculator. I'm going to assume for the time being that you're paying 50% tax. Now, those of you smart people out there will know it's actually 47.5 or whatever, but we're not going to get that technical hit. Simply half the tax. So you are going to pay to the tax man $10,000 and you're going to be left in your pocket with $10,000. Okay?
Correct.
Great. I've got 10 grand. Go spend it on a new car, holiday, whatever it is. Fantastic. Now, depreciation comes in before the income tax. So what do we say? Let's say we have $10,000 worth of depreciation.
Yeah, conservative.
So you're saying we take off $10,000 of depreciation. So now we end up with $10,000. Now, before we go forward, it's really, really important distinguishment to make here. That $10,000 of depreciation is what we call a non-cash expense. Now, the reason why that's important is you don't have to pay for it. You already paid for it when you bought the fridge, when you bought the building, when you bought the property. You know, whatever it is that you brought, you've already paid for it. So you're getting a deduction of $10,000, but you don't have just $10,000 in your pocket. You've still got $20,000 in your pocket. Now we go to pay the tax and we're going to pay half. So we pay $5,000. We end up with $5,000 in our pocket, plus we've still got this $10,000, which means all up we have $15,000. Okay? That is the power of depreciation, because I tell you what, whatever car you're buying for 10 grand, you can buy a hell of a better car for 15 grand. You can go on 2 holidays, perhaps even. And it hasn't cost you anything. Okay? Simply a bit of time to get this all set up, do the paperwork, get it right. And it's a really, really great strategy there. Not only are you paying half the amount of tax, who's not happy with that? you're ending up with $5,000 better off in your pocket. So really, really important distinguishment there. And I think hopefully the numbers help provide you a bit of a better understanding as to why that's so important.